Welcome to Talk Tickers, where we break down the earnings calls that move the market. Today, we're diving into Apogee Enterprises, ticker APOG. And this one, well, it's a bit of a head-scratcher. They put up some really solid Q2 numbers, but the stock got hammered. So what gives? Let's get into it. Right, so this is the big question, isn't it? Apogee comes out, they beat the estimates, so you'd naturally expect a good day for the stock, but nope. The market's reaction was pretty brutal. It really begs the question, what on earth did investors see that made them hit the sell button, even with a beat on the board? Okay, so first things first, let's just look at those headline numbers. Because on the surface, everything looked pretty rosy. They definitely cleared the bar that was set by the analysts. All right, so on the bottom line, Apogee delivered non-GAAP earnings per share of 98 cents. Now, the street was only looking for 84 cents, so that's a 14-cent beat. That's not just squeaking by, that's a really solid performance. You'd think that's a great start. And it wasn't just earnings. Look at the top line, revenue. It came in at $358.2 million. That's up 4.6% from last year, and again, it's well ahead of what Wall Street was expecting. So you've got a beat on earnings and a beat on revenue. Everything's looking good, right? Well, not so fast. Okay, this is where things start to get really interesting. Because when you dig beneath those big, shiny headline numbers, you find a much more complicated picture. This wasn't a case of the whole company firing on all cylinders. Not at all. It was really a tale of two different businesses living under one roof. And you can see that split right here. On the one hand, their services division was just crushing it. You had strong growth there, both organically and from a recent acquisition. And check this out. The architectural services backlog, which is basically their pipeline of future work, shot up an incredible 16% to $792 million. That's huge. But then you look at the other side of the house. The glass business was getting hit with pricing pressure, and the metals business was getting squeezed by higher aluminum costs and, you guessed it, tariffs. So a real mixed bag. You can even hear this in the CEO's own words. Ty Silverhorn said they delivered solid second quarter results, but also mentioned a dynamic operating environment. Now, whenever you hear a CEO say dynamic environment, that's your cue. That's corporate speak for we're dealing with a lot of tough stuff right now. It's a little nod to the challenges that were bubbling just under the surface. And that brings us to the part of the earnings call that really tanked the stock. It's all about the guidance, right? The market doesn't really care about what you did last quarter. It cares about what you're going to do next. And this is where the story took a very sharp turn. Yeah, this is pretty much where the music stopped. Management got very specific about the headwinds they're facing. You've got more competition hitting the glass business. You've got those higher aluminum costs hammering the metals segment. And then there's the big one, tariffs. They actually put a number on it, saying it would be a 35 to 45 cent hit to earnings for the year. That is a huge headwind to overcome. And all of this was basically the setup for the real gut punch, which was the guidance cut. They had to lower their expectations for the full year's earnings. The street was modeling something close to $3.96. Well, the new official range from the company is now $3.60 to $3.90. So the absolute best case scenario is now lower than what everyone was expecting, and the midpoint is significantly lower. That's a major red flag for investors, signaling that the back half of the year is going to be a lot tougher than they thought. So you can probably guess how the market reacted to all this. It basically ignored the good news from the last 3 months and laser focused on the bad news for the next 6. And the reaction was, well, let's just say it was not subtle. Just look at the trading volume here. On an average day, you see maybe 182,000 shares change hands. On earnings day, it exploded to over 665,000. We're talking almost 4 times the normal volume. This tells you people weren't just nibbling at the sell button. They were slamming it. This was a high conviction move to get out. And the end result of all that selling pressure? The stock finished the day down 4.44%, closing at $39.60. A pretty ugly drop, especially for a company that technically just beat expectations. So there's your answer to the big question we started with. Why did the stock plunge despite an earnings beat? It's the classic story. The future always trumps the past. And in this case, the future looked a lot cloudier, thanks to that guidance cut and all those headwinds they talked about. Okay, so that's the story of Q2. Now, let's switch gears and look ahead. This is our next call segment, where we give you our analyst take on what could happen from here. So our rating on Apogee right now is market perform, and here's why. On the one hand, you have to love the cash flow this company generates, and that services business is an absolute gem. But you just can't ignore the problems in glass and metals. Those margin pressures are the real deal, and that guidance cut is going to hang over the stock for a while. So until we see some of those pressures ease up, we think the stock will probably just move with the rest of the market, not lead it. All right, but what if you're looking for a more interesting way to play this? Here's a plausible, if a little out there, trade idea. Let's call it the services spin hedge. The core idea is simple. The market is punishing the entire company for its weak links, glass and metals, and it's completely overlooking the value of that fast-growing services business. So what's the catalyst? You be on the lookout for any talk of a strategic review or maybe an activist investor showing up and pushing the company to spin off that services segment to unlock its value. Now, how would you trade that? It's a classic pair trade. You'd buy Apogee stock to bet on that hidden services value, but at the same time, you'd short an industrial ETF like XLI. Why? Because that shorts position hedges you against all the broad market problems, like commodity costs, that are hurting the rest of Apogee's business. It's a way to try and isolate the potential upside from their best division.
So that's our breakdown of Apogee. And of course, we always have to say it, this is for informational purposes only. This is not financial advice.